All right, let's look at AIP payments to subscribers when beneficiaries do not attend post-secondary education. All right, so an accumulated income payment is a payment from an RESP made up only of income earned on RESP contributions, Canadian Educational Saving Grants, and other provincial education saving incentives. So the AIP provides a way for the income earned in the RESP to be withdrawn in the event that the beneficiary does not attend a qualified post-secondary education program. An AIP can only be paid to a subscriber, not beneficiary, who is a resident of Canada, and can only be made to an individual subscriber, not joint subscribers. So if like a husband and wife are subscribers to an RESP, it would be paid out to one of them. In addition, before an AIP is paid out, at least one of these conditions must also be met. The RSP has to be open for at least 10 years, and each current or former beneficiary is at least 21 years old and not eligible to receive an EAP. The RSP has been open for at least 35 years, or all of the beneficiaries of the RESP are deceased. So the payment of an AIP triggers the termination of the RESP. An RESP must be terminated and all funds paid out by the end of February of the year after the year it pays the first AIP. So that's confusing, but it has to be paid out. Say if has to be paid out by the end of the February of the year after the year. So if you apply for the AIP in like 2023, it needs to be paid out totally free of all funds by February of 2024. So this is a bit of a long one also, but when an AIP is paid and an RESP is terminated, any grants or bonds in the account are returned to the government who issued them. So you don't get to keep the grants and bonds that were that the government contributed, but you can keep the interest earned on it, the income earned on it. So the AIP is taxable to the recipient at their regular income tax rate plus an additional 20% penalty tax. So that's significant. It's your interest rate or the subscriber's interest rate plus 20%. The total amount of tax due on the AIP is calculated when the taxpayer files their yearly income tax return. So let's just look at an example of how this AIP is taxed. So Pansy has received a $10,000 AIP withdrawal from her RESP account. The amount is fully taxable, and if she were to include it in her income for the year, she would have to pay at her regular tax rate plus an additional 20%, calculated on the amount of the AIP. If her regular tax rate is 30%, this would result in a tax bill of 50%. I'm just showing here. So her regular tax rate is 30%, so $10,000 times 30% is $3,000. The penalty tax is 20%, so $10,000 times 20% is $2,000, making her total tax payable of $5,000. So if she just keeps this AIP in cash and deposits in her account, it will cost her half of the amount.